No one hasn't heard of Warren Buffett, the world's most successful investor, known as the investing genius, financial legend, and wise man of Omaha. Today, I will sympathize with him and discuss the financial concepts and tactics he employed to achieve success in the stock market. Principle number 1: don't lose money. The first guideline advocated by stockbroker Warren Buffett is don't lose money. This phrase is also associated with the compound interest effect. He frequently uses snowballs to teach the notion of increasing money. Consider rolling a snowball from the summit of a mountain. The fist-sized snowball begins to roll down the mountain, growing larger and larger until it is nearly all the way down and becomes a snowball the size of a group. Because the process of producing this snowball is comparable to that of growing money, it was given the name snowball. If you make a loss, you will also suffer a loss due to compound interest. Also, while the loss is negative in and of itself, recovering it requires a higher rate of return. For example, if you lose $50 on $100, your loss rate is 50%, but if you want to make $100 again, you must return 100%. That is why Warren Buffett chooses to protect the principal over seeking immediate profits. The emphasis is on finding the best earning opportunities. Rule 2, don't forget Rule 1. Through this second principle, you can see how much Warren Buffett emphasizes the protection and preservation of principal. Rule 3, do not incur debt. The third guideline is to avoid incurring debt. It is a market in which no one knows what the stock price will be in the near future. Regardless of how strong a firm is, its share price might be affected by a variety of factors. This is due to the fact that there are numerous variables at work in the backdrop of stock price creation. Value investing entails purchasing stocks at a cheap price and holding them until the stock price approaches the company's intrinsic value. Investing with debt disadvantages you in the race against time because it is a waiting investment approach. To put it another way, you should only invest what you can afford. It is critical to invest without going into debt. Here's how to do it. Warren Buffett is well known for being a master of value investing. Value investing is an investment strategy in which you buy inexpensive assets and wait for their value to rise over time. There is a common misconception that long-term investing is a safer investment strategy when purchasing stocks or assets. However, from a risk management standpoint, long-term investing is considered a riskier investment approach than short-term investing. The longer the investment period, the more factors and dangers influence stock values since they rise in tandem. Before investing in value, consider how long you intend to invest. If you're not going to own a stock for 10 years, don't own it for 10 minutes, Warren Buffett once stated. As if acquiring a company, it is prudent to base investment selections on a variety of publicly available information. Prices that alter owing to short-term difficulties or economic downturns are only one cycle in terms of long-term price fluctuations. To choose a company that will grow over time and provide consistent profits, consider the net asset to price, PBR, price to earnings ratio, PER, and other management indicators such as return on equity, ROE, dividend payout ratio, and growth potential. My thoughts are summarized below in a nutshell. During bull markets, investors are very human, and they get quite excited. I made money last year, so I'll make more this year, you say to yourself as you look in the rearview mirror. So this time I'm going to borrow money and invest, or last year I didn't invest, but my stupider neighbor made a lot of money by investing? I want to invest this year as well, he continues, his gaze fixed on the rearview mirror. If you look in the rearview mirror and see how much money you've made in the last few years, you'll rush in and raise the price. When you check in your rearview mirror and see no earnings, you excuse yourself by claiming, "This floor is not a good place to be." They genuinely don't care about what's going on in the industry. Isn't that right? Let us take a step back and reflect. I believe you know a lot about Apple. If you have invested in Apple in the last year, you have lost money. When I look back in the rearview mirror, all I see is complacency. This floor isn't for me, or I'll climb it someday. Can you grasp and explain Apple's business and the risks it has faced in the last year? You should take this very seriously, and as I previously stated, it's understandable if you don't care what's going on with your business. It's incredible, but it's true, and because it's like this, it opens up a great possibility. This is because most people overlook stocks with excellent investment potential, and when the stock price rises, a large number of individuals acquire them. Based on my previous experience, I encountered stagflation during the last extended investment period, during which equities plummeted dramatically. People react in bizarre ways. Because you are a human being. When others are happy, they are happy, and when others are sad, they are sad. They will keep doing so until the stock market closes. In your lifetime, you will witness incredible events in the stock market. America will continue to fare well, but there will be significant swings. You will become very wealthy if you can act objectively throughout that era, if you can detach yourself from the majority. You don't have to be as clever this way. Only the ability to observe anything is required, and only those with serious thought can succeed in the stock market. I hope you will be as well, and I will return with more important knowledge in the upcoming video. Thanks for watching.